The Lloyd's List Shipping Podcast from Lloyd's List Intelligence, delivering you expert analysis on the stories shaping shipping.
As anybody looking to renew a fixed-rate mortgage right now will tell you, these are tough times for those seeking to borrow money. The decade and more in which the outlook for interest rates were lower for longer as central banks sought to encourage economic activity in the wake of the global financial crisis, well, that's just a memory. The new enemy is inflation, which has jumped dramatically in the wake of Russia's invasion of Ukraine last year. Policy rates in most major economies have risen sharply, and while the forward yield curve suggests that they're expected to moderate in the next year or two, we are living through interesting times. For ship owners looking to bankroll expansion, the market seems bifurcated. Those that raked it in during the post-pandemic boxship boom, or perhaps are benefiting from current tanker rates or can point to charter backing, well, they may be finding it easier than some. But that isn't most ship owners. Smaller operators, and lest we not forget, that is the majority of the shipping industry, they are having to pay high single-digit and even low double-digit percentage point interest rates, which, by historic standards, represents expensive money. Increasingly, they are turning to Asian leasing companies because European bankers, well, they no longer have their backs in the same way that was common until the late 2000s. So for this edition of the Lloyd's List podcast, which is sponsored by our friends at Wirana, we are lifting the lid on what is happening in ship finance. We convened a special panel discussion for this one, and our guests were industry veteran Dagfinn Lund, a high-profile figure who has built his career at DVB, Det Norsk Bank and Intertanko. He now runs the online ship finance platform eShipFinance.com. Andreas Povsen, a Breakwater Capital alumni who now heads the maritime team at alternative asset manager Hayfin, and star lawyer Kavita Shah, a partner at the asset finance group at Watson, Farley and Williams. She puts together the contracts that makes the deals happen. Moderating the panel is Lloyd's List's very own insurance and finance editor, Mr. David Osler, who opened the discussion this week by asking our experts to give us their big picture take on what's happening in ship finance.
The fleet in the last 15 years have increased with 40%, and the bank lending has gone down with 40%. So it's a dramatic gap happening in the market. If you look at the difference between what is needed normally at leverage and what is offered at the moment from the banking side. So I made a small list of things which seem to be filling up. Part of that is, of course, that they have profitability again, so they don't need that much loans. And we see also that a lot of export credits and guarantees are used for new buildings. And we have not the least seen many private equity firms coming in with a lot of capacity, both on the equity but also on the lending side. And in general, with the good markets, the shipping companies are leveraging down in order also to be able to pay dividends. So that's how the gap is being filled at the moment, David. And this was my kind of opening.
Yeah, I'm going to come to some of those themes later in the questions. But Kavita, you're a lawyer. You help write up the contracts that govern many of these deals, I guess, so you've got inside knowledge. What are you seeing?
Well, I mean, I think the banks are there, but the problem is that they're all chasing the same deals. So there's a lot of competition amongst the banks, all trying to lend to the sort of same tier of borrower, let's say. And I think, as Dagvin says, there are sort of opportunities for alternative lenders in the rest of the market. But I think also, let's not forget that banks are facing an ever-changing regulatory framework. So they've got the sort of general regulation coming in year on year. And if you overlay on top of that, the sort of ESG challenges, the green policy of the ECB, it makes it a really challenging market for European banks, I would say.
Okay, and talking of alternative lenders, Andreas, you probably would see yourself in that category. I mean, what do you think?
Yeah, I think it's right. I mean, we obviously both play a role on the alternative lending side, but also in the equity and ownership side. But we can get back to that. I think, in a way, it's almost been surprising because Darfing's numbers are obviously correct in regards to the growth in fleet and in at least on the headline numbers, reduction in amount of lending from traditional banks. But interestingly enough, I do feel that we've seen more availability nonetheless. And as Kavita said, certainly the bigger players, the solid players with the modern tonnage, are seemingly not finding it difficult to get attractive loans from the big players. And if you include Chinese leasing and Japanese financing and so forth, the market seems reasonably supported. And I think it's a little bit like in many other industries. It's kind of like either you have it and you can get it at competitive pricing, or you don't.
Yeah, you're making a point about the division there between ship owners of different standings. I mean, like any other business, I guess, the blue chip companies can fund themselves cheaply. But on the other hand, I'm hearing that interest rates on some of the riskier deals for smaller ship owners are well into double digits, which is what we used to call junk bond territory. So, what kind of margins are available by type of owner, from the big guys down to the two ship companies?
Yeah, well, I think it's not just a question of the balance sheet and the owners. It's also the question of what type of tonnage and obviously whether you have charter commitments and so forth. And I think generally what is really interesting and hopefully a positive for shipping going forward is that it's becoming more industrialized. Obviously, there is a bit of a nostalgia towards the charm of the smaller owners with smaller setups and so forth. But I think because of compliance, because of ESG, because of regulations, it will be more and more difficult for the smaller owners to really fill a gap in the market. And therefore, both because the end users, the charterers, are looking for the bigger, more solid counterparties, and because the banks as well are looking for that, it will be harder and harder. So, as I say again, it's not just a question of margin; it's a question of whether people actually can get those loans at all. And when you're in an interest rate environment that obviously has changed fundamentally, where we went from virtually borrowing money at nothing to base rates of, depending on 3 months, so for LIBOR, whatever, of 5+%, well, it's suddenly very costly to borrow. So almost whatever margin you're paying, the base rates obviously changes the calculations a lot. And that is also where, even if you can get the money, there will be people who are not interested. So certainly right now, from a leverage perspective, many of the bigger players will also say, well, why should I, even if I get a margin from the top tier names of 1.5% to 2%, it may still not make sense to take very high leverage. So that's obviously taken some of the need out of the market, that some owners just don't want that high leverage.
Okay, Kavita?
I'd probably just add to that there aren't so many new buildings on order either. So either that's a sign of not the right time to invest, or also technology plays into it. You know, as we are in this ESG journey, people are sort of not ready to commit to one answer or one solution at this point in time. And so I think that also feeds into it. And were there to be more new building orders, then that would probably increase the sort of appetite for borrowing from a borrower's perspective.
I would like to disagree a bit with Andreas here on the funding issue, because it's very clear that the banks go for corporate credits and balance sheet lending. We see that on all the bank leagues for the first half year this year again. But we, in our game, we are running this eShip Finance platform on the internet. And you can easily, in my mind today, finance a single ship if the name is reasonable, and especially if they have employment. But we see a lot of 2 ships to 10 ship companies. And we have even seen special offshore projects, which was before the offshore boom started, which were financed by private equity. And unfortunately, the margin or the interest rate was high, it was over 15%. But still, for a 1 year deal, the owner made $10 million in spite of the interest rate. So it depends on the project. And the private equity is very flexible in terms of what they are willing to finance. So in our view, everything we have seen basically of decent project which makes sense from a market point of view and from a segment point of view, they have been financed.
I think, Hayfin, again, that's not incorrect when you're talking about the wider universe of lenders. I think from my perspective, when you're talking about the banks, that's where there's a very, very strict focus on more modern assets, on, as you said, the corporate players and so forth. The private equity funded, or let's say the alternative lenders, of course, there are some people out there, and I think as David mentioned as well, obviously the rates there or the margins are much higher. And again, from some of those providers, you can see higher leverage. It obviously provides a lot more risk into the projects because is it really sustainable to be in projects with very, very high leverage and high interest rates? I have to say, from our own perspective, we really feel that what is critical for the ship owners, it is that they feel that the lenders they're working with are partners. They need to know that they're there not just when it's good times, but also when you potentially have downturns or you have big events like COVID and so forth. So you can sit down around the table and find a solution that means that the ships aren't just going to be taken over or that the owners no longer have use of the vessels. But I think on the lending side itself, the alternative providers are still there. I would say, again, from our perspective, we probably see ourselves more on or closer to the banks, where we would say, okay, we will do very large deals. Our sweet spot is probably more like $50 to $250 million. You know, we can do more flexible structures and are probably more active in many of the markets when the banks are a little bit reluctant. And then finally, obviously, on the pricing side, we are probably closer to the range of the banks, especially when you're talking about the current base rates. If you're looking at the alternative lenders and you're looking at the high LTVs, we would probably rather in some of those instances say you're taking such high risk that it makes more sense to be an owner of that asset. And especially if you talk about offshore, where you're very correlated to the commodity that you transport, you're really beholden to the oil price.
Okay, I am going to pause the conversation there for a moment for a message from our sponsors for this edition of the podcast, Wirana.
Wirana Shipping Corporation is the oldest and one of the largest cash buyers of end-of-life ships and offshore vessels in the world. During 40 successful years, Wirana has earned the trust of ship owners, ship recyclers, and all the stakeholders in the industry for always honouring our commitments irrespective of market factors and for being a responsible stakeholder. Wirana has well understood that continuous adaptation and learning the changing requirements of the industry is the key to success.
Thank you, Wirana. Your support is very much appreciated. Now, back to the podcast.
We're currently going through a period of high inflation, and of course central banks are fighting back by putting up lending rates. Now, that brings me to the pros and cons of taking a fixed interest rate deal and interest rate swaps. I mean, I've heard arguments from some lenders that ship owners like the certainty of knowing what they're going to be paying so that they can get on with operating their ships. And I've heard others say that it's foolish to lock into what could be a high interest rate now when I suppose the consensus expectation is for interest rates to drop as inflationary pressures ease. So what would be your advice? Lock in or look for a swap?
From my side, on all the projects we are involved in, we just say keep it floating, because even if we have 25 or 50 basis points more on the upside, over the lifetime of a loan, you will definitely see a better market or lower base rates. That's what our advice is very clear.
I think that, again, if you look back at what happened on the interest rate side and inflation, obviously there seemed to be quite a lot of voices out there that in hindsight were a bit naive in regards to the transitory inflation pressure. And I think what is a little bit different this time around is probably that part of it is driven by what we believe to be underinvestments in commodities and so forth as well. You're still seeing oil prices quite high. You will see, especially based on the need for energy transition, renewables, commodities, nickel, zinc, copper, and so forth, there's going to be a lot needed going forward. So I think there is an argument for inflation could stay higher for longer, and that's obviously what you're seeing now on a US interest rate basis. But I think when it comes to the specific shipping question, it depends on what kind of project you have. If you have long-term offtake with long-term contracts, then even in this interest rate environment, maybe it does make sense to make sure that you are not at risk for further increases. But I think in normal circumstances, obviously there is a little bit of logic to saying that the ups and downs of shipping in a spot trading ship has a bit of a natural hedge from an inflation perspective.
Right, Kavita?
I probably just add to that, it depends, and probably depends on sort of how much cushion you think you have, in terms of your operations. But what I would say is that when you do see, you might find a scenario where other things aren't working well. For example, values have gone down substantially, and so you're facing covenant breaches in that regard. But if you have fixed your interest rates and you're in the money on a hedge, then perhaps the bigger picture looks much better. And there you find sort of a syndicate of banks, assuming they wear both hats, a lender hat and a hedge bank hat. Maybe everything taken into consideration, it buys you a bit more time and you can kick the can down the road for a bit longer.
Right. On the other side of the coin, of course, a lot of owners have made a lot of money in the last period and understandably used it to pay down debt. Now, it's probably going to be a long time before the good times start rolling like that again, but how is this affecting willingness to lend?
Well, David, I think you are wrong on the issue of that the profit will not float again or profit come again in shipping. What I see is that at the moment you have a tremendous upside on the product tankers still, and on the crude tankers there is still a very nice upside. And as you also know, the bulk market is pretty low at the moment, and within 2 years, for instance, there seems to be a nice upside again. What is characterizing the market is a lot at the moment, of course, the huge effect in the container market. The bigger container ships had these super profits, and it more or less crashed. But even if you look at the size of container ship under 5,500 TEU, it's still a very decent market. So I don't see that profit will not exist in shipping. There will be a lot of it still.
I mean, from my perspective, what I'm seeing is that a number of lenders, banks in particular, their sort of portfolios have shrunk as a result of cash-rich owners having prepaid their loans early, and that has meant that those banks are not wanting to sort of they have a lot of capacity, and so actually, rather than sort of refraining from lending, they're really looking for opportunities to lend. But the challenge is to find the sort of deals that fit their risk profile. And I would say that those lenders who are potentially more flexible and adaptable in their thinking perhaps will succeed in sort of refilling that capacity.
Kavita is very right. Kavita is very right on this, and you see this dramatic change in the market at the moment. Let's say last year containers were over 20% of the lending market. Now it's under 10, and the opposite happened in offshore. It went from let's say 2-3% to over 25% in a very short time. So the market also for the banks, as Kavita is saying, is changing. But it's amazing to see how many banks are eager to lend at the moment because of prepayments and so on?
I agree with both. I mean, I don't think that there are that many banks in theory, but the ones that are there are chasing many of the same things. And again, as Kavita pointed out, it means that for the right structure, for the right company, you get very tight margins. And you were asking before, that can be starting with a 1. It certainly starts with a 2 for many of these different companies. So very competitive margins. But obviously, at the end of the day, the base rates are still high. So as I say, even if you borrow at 2%, you still margin, you still pay more than 5% on top of that. So it still needs to be logic. What I think is quite curious and certainly interesting for shipping is obviously that in the big picture, shipping from an importance is very critical in regards to transportation and 90% of world trade and all the things that we talk about. And from a energy transition perspective, should also be well placed, both because it's a better way of transporting cargo than trains and trucks and planes. But when you look at the investor focus and you look at the market share of the biggest shipping companies, the 50 biggest shipping companies are only like 260 billion or something like that, whereas Exxon on its own is 460 and Tesla would be 800 plus or something like that. So in the big picture, we are obviously still, from an investor perspective, not that important. But if you look at what is happening on the lending side, it is interesting that even in a market where earlier this year, if you look at the general corporate borrowings, both from alternative and banks, pricing and volumes were quite low, and even large private equity firms were struggling to get corporate deals financed. And even in that environment, the niche bank lenders were able to provide loans to shipping companies. So I guess that is good news. It means that, even in an environment where some of these banks were struggling with their balance sheets in regards to being stuck with some big loans like Twitter and so forth, they were still able to, in some of their other areas, to lend to the shipping markets.
Okay, another claim I've heard is that the shipping boom has made lenders more relaxed about loan-to-value ratios. And in some cases, they're being offered as high as 120% of the historic rather than the current value of the ship. Now, nobody gets that kind of deal on a mortgage on a flat anymore. So is this asking for trouble or is this sustainable?
This must be for Kavita. Huh?
I mean, I was going to say, I'm not seeing that in terms of actual, documentation, things have changed, as a result of the cash-rich nature of the industry in recent times. But obviously, in terms of lenders' attitudes to how they treat these sort of covenant breaches, which will, of course, inevitably come as the markets turn, maybe there will be more tolerance in a situation where other factors look good, i.e. there's lots of cash sloshing around in the, owner's business. But obviously, I think it cannot ever be one size fits all because it will depend on the regulatory framework of the lender. So, for example, a US lender may be, from a regulatory point of view, having to put up capital for any breach whatsoever, including an LTV covenant breach, and that means a cost to its business, and that will inevitably filter down to their owners. So it will depend on their own challenges as they face these sort of situations.
Well, I think generally,
it's the same in Europe in general. That the very moment the loan is graded down from the full performing loan, a capital increases immediately.
I think what you're seeing, David, is generally that for the solid owners, for the modern ships and so forth, the banks or the bigger alternative lenders are there to provide the loans. I think where you could be worried about what's going to happen going forward, even if you believe that the markets are reasonably solid based on both demand and on supply, is for some of the smaller borrowers with more niche type assets and where some of the small alternative lenders or very small banks will provide quite high LTV and with high margins, which could be a recipe for difficulties going forward. And you're going to see the EU ETS coming in beginning of next year. Older ships could have difficulties from that perspective. Again, I would just highlight that it's not that it's only about methanol and ammonia going forward, but if you have quality ships today, you can do a lot to retrofit them with different type of abatement technology, whether that be air lubrication or wings or silicone paint and so forth. So there's a lot that can be done to make current vessels high quality, but you got to make sure you start with a quality ship.
Right. Now, research by Ted Petropoulos of Petrofin, well-known ship finance figure, of course, found that in 2022, for the first time ever, the European share of bank lending fell below 50%. And I guess the only real surprise is that the retreat has taken as long as it has. Is there any way back?
No. No, it for me, it looks like the situation in the shipping market when you remember 30 years ago, you had a lot of European shipyards. A lot of ships were built in Europe, and that has changed.
That's the difference.
So I think the regulation and the cost level and you see as Kavita says, and Andreas also point out, the regulation for banks have become extreme. And I remember even 10 years ago in DVB, we calculated the cost of bringing a new customer into the bank. At that time, it was $250,000 per new customer. So it's tough. That was 10 years ago.
I think that it's also natural based on where the epicenter of trade has moved to. More Asian banks and also more alternative lenders, not just in shipping, but generally you're seeing a bigger and bigger role to be played by private credit in all kind of industries. So yeah, I think that's probably here to stay.
Any thoughts, Kavita?
I was just going to say, perhaps with the sort of importance of energy transition and that angle playing into all of this, I could see a situation where the shipping desk of a bank alone is not the only desk within a bank that looks at maritime deals, and therefore there could be greater lending into the maritime industry by virtue of the fact that multiple desks within a bank are lending into the industry. But obviously, it would take sort of a lot for that figure to sort of drastically rise the way we would need it to go back to those historic figures.
I think it's actually a very interesting point. Sorry, David, just on investors in general when it comes to maritime. And I think what I started out by saying is it's becoming more industrialized. And I think it's interesting also with the type of money that's coming into shipping, because what you have seen is right now, private equity has probably been busier exiting some of their very old investments that took a very long time either not to be successful, or if they were, it just took a long time. But what you're seeing is probably longer term capital. And this is where all these things need to come together, whether that is infrastructure capital or it's setups like ourselves as well. Also, what we're looking at, not just single assets or whatever, but building diversified portfolios where you're really looking at partnerships with the end users. And you need that. You need the end users to step up to support dual fuel engines and so forth, because it's not cheap. And you need longer term offtakes. But if that happens, just like Kavita said, that will bring different type of capital from the equity side, including infrastructure and longer term money, as well as on the lending side, where it will be much more efficient and will kind of bring the maritime industry into another scale, I believe.
David, can I just go back a bit to your reference to Petrofin, that report? Because I studied that some time ago, and if you look at that, it's the German market which went down 90% in 10 years, and a bit the Scandinavian. But if you look at the French, they have more than doubled the last 10
point.
years.
Good
It's a
point.
very varied situation, even within the European reduction, as he points out.
Yeah, as you say, it was Germany that was that fell over a cliff basically after the shipping downturn. And finally, question about capital markets. I mean, we've had one shipping IPO in New York this year, the first for some time, if memory serves, and there was the Taylor Maritime listing in London in 2021. So these deals are happening, but not in any real volume. Is that situation going to continue?
Well, it looks like that because the companies, if you look at the companies today, and we have pointed that already earlier in the discussion, that they are very profitable. And in this market, they have definitely focused on, and they will also now for the long period, focus on dividends. And until, and here we comes back to a bit what Andreas was talking about, it's a question of when they now go into new buildings, because you know that within, you cannot get a new building now within 2.5 years anyway. And that will happen when the new ship types get clear, and when people start to think about renewing their fleet, that will definitely happen. So then we will see more capital needs coming.
I think, again, if you talk about where the money is coming into maritime right now, again, infrastructure for long-term projects, you also have some PE investing in more of the technical managers and the tech companies. If you talk about the listed side, as I mentioned already, it's quite small compared to many other industries. It's hard to see that changing fundamentally unless that maritime really becomes differentiated on the platforms because they become industrialized, because they can use AI or generative AI on the technology side to really be part of energy transition and so forth. You probably need something fundamentally different to really be seen as being game changer. Obviously, some of the big players like Maersk and so forth on the container side made so much money that they invested that in logistics and warehouses and so forth. So they're also becoming slightly different type of companies again. But for the pure shipping side, it can be hard being a listed company, because when you really do need to invest, that's when the investors maybe are focused on other industries.
I would add to that we should not forget in this discussion also the big bond markets, which have been used extensively.
Right, Kavita, what deals are you helping with?
So what I was going to say was interesting to see from our perspective was that a number of companies who are already listed looking to be dual listed, and that may be a sort of precursor to moving jurisdiction of listing, which may be, I mean, could be for many different reasons, but that is also an interesting trend to see, because obviously, depending on the sort of local market and the coverage for their stock, that appetite will differ, and so that is something we as a firm have been helping a number of our clients with. I would say also a lot will come down to cost and general compliance. Obviously, the sort of disclosure requirements vary from the different stock exchanges, and that can be quite onerous for shipping companies with the nature of their business and the way they operate across different jurisdictions, carrying different produce, etc. So that can be quite challenging for a company, and the sort of repercussions of getting it wrong can obviously be quite severe.
Right, well, thank you very much, Kavita, and thank you, Dagfinn, and thank you, Andreas. That was a great discussion, so looking forward to that going out to our listeners.
And that is where we are going to leave it for this special edition. My thanks to Dagfinn, Andreas, and Kavita for giving up their time. Thanks to Dave for chairing the discussion. Thank you again to Warana for sponsoring, and thank you for listening. I'm going to leave you with this thought from the late American journalist Hunter S. Thompson, one of Dave's heroes, obviously, who described the music business as a cruel and shallow money trench, a long plastic hallway where thieves and pimps run free and good men die like dogs. There's also a negative side. Thank goodness the shipping industry isn't like that at all, in any way.